نختم هذه الجلسة الصباحية مع تجربة رئيس منطقة الشرق الأوسط وشمال أفريقيا في ميريل لينش الأستاذ فارس نجيم، الذي سيقدم عارضاً موضوعياً لعملية السقوط الكبيرة في الولايات المتحدة، تجارب وعبر من بير ستيرنز إلى ميريل لينش. أستاذ فارس نجيم، تفضل.
Well, عن جد من بعد سعد, it's going to be a presentation hard to beat. First of all, I also want to thank First Protocol for getting the invitation, so thank you for inviting Bank of America and Merrill. كنت عم فكر بشيء وقت أستاذ وليد المندين قال على الستريس تيست تبع البنوك اللبنانية، إنه اللبنانيين بضلوا سابقين الدنيا بكل شيء، حتى بالستريس تيست سابقيننا فيها. نحن بعد ما خلصنا من الستريس تيست بماي، أول ماي راح يخلص الستريس تيست، إن شاء الله ننجح مثل ما البنوك اللبنانية ناجحة، بس صعبة. I'm going to do this in English because it's much easier for me to do it in English. Putting things in context, we're talking about the Lebanese economy. Total GDP of Lebanon was around $30 billion. Well, Merrill Lynch lost $30 billion in net last year. So putting it in context is always interesting. This was 2008 in particular, and the credit crisis in the United States started in 2007, but really took hold in 2008. And it was a year that Wall Street disappeared, and yet the Lebanese banks are still standing strong. So it's been an amazing achievement. I wanted to share with you at least my experience, having gone from vice chairman of Bear Stearns, spent 22 years at that firm, to what I thought I was moving to Merrill Lynch as president of MENA and running our sovereign wealth fund business. Merrill was the largest brokerage firm in the world. At its peak, had 76,000 employees, relative to Bear Stearns' 16,000 employees. It was the biggest brokerage firm in the world, and yet in 2008 we had to sell ourselves to Bank of America to survive. In terms of 2008, putting some numbers in context, the total GDP of Lebanon is almost 30 billion. The total of GDP of the United States is almost 14 trillion. So far, and we're not through this credit crisis, so far the United States, between the Federal Reserve, the US Federal Reserve, between the Treasury Department, has pumped in, depending whose estimates you want to believe, anywhere from 10.5 trillion to 14 trillion of liquidity in just the US markets, between the economy and the financial markets. And it's done it through so many vehicles that too many to name, from Troubled Asset Relief Program, FDIC, bank takeovers. FDIC, so far in 2008, which is our regulator for the banks, 50 banks have failed at a cost of 21 billion. And that's just, I'm talking about commercial banks. I'm not adding the finance companies. I'm not adding the mortgage companies. IndyMac by itself lost 10.7 billion. IndyMac is was a large commercial bank and a large mortgage bank. The U.S. Treasury has invested $200 billion in the U.S. banking system, and that's what's kept the U.S. banks alive. Now, the U.S. is not the only one in this situation. Frankly, every European economy or European country, every Asian country has done something similar to its banking system. Basically, the world banking systems failed, and yet again, Lebanon's a great example of a success story where the fact that the Lebanese banks were conservative in their approach to the world saved them, where we thought we were smart and Wall Street ended up paying the price. Anyway, we used to talk in a world not too long ago, we used to live in the world not too long ago where $1 billion was a lot of money. And to some Lebanese here, maybe $1 billion is not a lot of money, but now we're talking trillions. And it's still not a lot of money to get liquidity back into the marketplace. I named my presentation, and I'll do this relatively quick because it's between me and lunch with some biking friends at Beltus, so we'll do this relatively quick. The title of my presentation was From 383 Madison to 1 Bryant Park. 383 Madison, it was the address of Bear Stearns. It was a building that Bear Stearns, we spent $1 billion building in 2002. Some of my friends here have visited, and we were proud of that building. I moved to Four World Financial Center, which was the world headquarters of Merrill Lynch, and that lasted about 4 or 5 months before we had to sell ourselves to Bank of America, which they're located in 1 Bryant Park, which is in Midtown in Manhattan. And they've spent north of $1 billion building their own building. So having had the I guess, luxury or in the middle of seeing the Bear Stearns experience unfold. And Bear was the first firm that, for lack of a better word, failed, where the Federal Reserve had to come in and rescue it and broker the sale to JP Morgan. And it was interesting because what Bear proved to the market is that the impossible became possible when a $500 billion firm can disappear literally in 3 days. It went from Thursday night to Sunday night, from March 13th to March 16th, where we had to either file for bankruptcy or sell ourselves. And both choices for a firm that was in existence since 1923, never had an unprofitable quarter, let alone an unprofitable year. Wall Street's quick demise, and it showed. Once the market saw that a $500 billion firm can disappear, the rest of the firms actually became relatively easy, with the hedge funds attacking from Fannie Mae to Freddie Mac, these banks that I just mentioned, and one after another, it just went after them. And what it turned out, unlike the Lebanese banks, the U.S. banking system was over leveraged. Putting in context, Goldman Sachs at its peak, Goldman is an investment bank, U.S. based but global investment bank, that had leverage of 43 times to $43 of debt for every dollar of equity. So putting it in context, that's like someone coming to you and saying, I will lend you $43 for every dollar of equity that you have. And Demco Steel, I'm sure if somebody had come to them and said, hey, we'll leverage you 43 to 1, they can increase their profits the way Wall Street increased its profits. And Merrill losing $30 billion in 2008, we basically lost the profit that we made in the last 10 years. So just putting it in context. What started off as a credit crisis started really with the U.S. housing market. Just putting some numbers also in context, there's an index that we on Wall Street follow. It's called the S&P Case-Shiller Index. In 1997, it stood at 81.8. By the end of 2006, it was 188.7. So if you had $1 invested in real estate, it went up anywhere from 2.5 times to 3 times. And that's just a generic benchmark. A lot of real estate way outperformed that general number. Some of the factors that drove this boom were historically low interest rates. After 9/11, After 9/11, the U.S. Federal Reserve drove interest rates down almost to 0%. And that just brought a lot of liquidity into the marketplace, brought a lot of reaching for yield, brought a lot of aggressive culture to Wall Street, and we were constantly looking to make the next profit, the next quarter, the next bonus. And the Lebanese banks have actually learned from that. They're increasing their bonuses, so hopefully they won't go down the path of the U.S. Wall Street that we went through. But this bubble continued with U.S. housing prices just continuing to increase, and that fed a cycle of leverage into the U.S. economy. Default rates were low, and that just kept driving up U.S. real estate prices. This situation reversed in late 2006. Central bank governor here did a great job of not letting the Lebanese banks buy, and these structured products were mainly linked to the housing markets, the United States housing markets, but also the European housing markets that were fast declining in value. It was hard to sell them. It was hard to evaluate what they actually were worth. It was hard to evaluate the risk in them. And to add to the problem, the whole banking system was dependent upon the credit markets to feed its growth. And when the crisis hit, the credit markets basically shut access to any bank that it deemed way too leveraged. I mean, I mentioned to you the Wall Street has changed or has disappeared. And what I mean by that, there were 5 Wall Street firms. There were Bear Stearns, Merrill Lynch, Goldman Sachs, Lehman Brothers, and Morgan Stanley. Lehman, Merrill, and Bear Stearns totally disappeared. And the only reasons Goldman Sachs and Morgan Stanley are alive is that the U.S. Federal Reserve allowed them to change their charter from an investment bank to a commercial bank overnight, and therefore gave them access to funding that the Federal Reserve and the Treasury was letting them get access to, which as an investment bank, they weren't allowed to get access to that funding because the credit markets were not financing their balance sheets anymore. And these are firms that have been around for certainly, even in Lebanon, what we deem old. I mean, Lehman Brothers was founded in 1850. Merrill Lynch was founded in 1914. Bear Stearns was founded in 1923. Goldman Sachs and J.P. Morgan, early 19th century. And all these firms just disappeared. And they weathered many, many crises, from the Great Depression to the crash of 1987, and yet this credit crisis was the actual tsunami that took all these firms down. So I think in terms of the lessons between Bear Stearns and Lehman Brothers, a lot of similarities, and Merrill Lynch for that matter. The role that the hedge funds played in terms of shorting the stock, the role that the rating agencies, which the markets really haven't focused on, but the rating agencies for the first time started using the stock prices of these individual firms as a benchmark to either downgrade or upgrade, and that had never happened before. So it became a self-fulfilling prophecy. As the stocks of these financial firms went down, the rating agencies downgraded the ratings of these firms. Bear Stearns went from a AA to a single A to non-existent in less than a week. And these were the same firms, the rating agencies, that were pushing Bear Stearns to get more aggressive, to start leveraging its balance sheets. So it's interesting, and I know the rating agencies here are playing a role in Lebanon as well in terms of rating the Lebanese banks. So I think what the credit crisis forced the U.S. system, forced for the first time ever, and this is when I mentioned the $10.5 trillion to $14 trillion of liquidity that the U.S. government has pumped into the U.S. economy and to the various financial institutions in the United States. It forced the government to step in and be the provider of that liquidity. Right after Lehman Brothers failed, or went bankrupt, which was September 15th, literally, I think the world for that first week, we were at risk of total systematic failure. Total failure of liquidity just drying up. Even in the Lebanese banks, as solid as they were affected by this. And if the governments worldwide hadn't stepped up and provided that liquidity, the whole system would have crumbled. And so we came this close. I guess to me, the two big overlying questions, and I will leave you with, is this the end of the universal banking model? Something that the Lebanese banks are actually on their way to achieving on a regional scale, but not much different than the U.S. banks had done. What, at least so far, and the jury's still out, it's not completely closed, the universal banking model had not worked, at least in the United States and in Europe. So I think you're going to see the banks in general get back to being much more conservative, much less leveraged, much more dependent upon actually making loans that work, making deals that work in their investment banking businesses, and having much better systemic risk management, because the risk management of the global banking system failed. It just completely failed. Now, and this is where history is going to be the ultimate judge as to who is responsible and what better tools are we going to have for the systematic risk to measure it. So time will tell. Anyway, just wanted to be brief, share with you our thoughts on credit crisis. And I'm sure we'll have some time to take some questions if you guys want. Thank you very much.